Hello, and welcome to myfinancesteacher.org. These few days have been crazy in the markets. Last week, the stock market dropped by over 15%, and this week, yesterday, the Fed announced an emergency, unexpected rate cut of 0.5%. Before we continue, let me remind you guys to subscribe to the channel if you haven't, and click that bell notification. Thanks a lot. The last time an emergency rate cut took place was all the way back in October 2018. Usually these rate cuts or rate hikes are announced at the time of the scheduled FOMC meetings. The Fed couldn't wait until the next meeting on the 18th of March and decided to have an emergency cut yesterday on the 3rd of March for the US markets. And you know what's really interesting and also kind of funny and also kind of exciting for me? Look at this red candle for the 3rd of March. Despite all the efforts of the Fed to push the markets higher, the market still ended up dropping on the 3rd of March and it couldn't hold this 200-day moving average. It closed below that moving average. So what this tells me is even an unexpected rate cut of 0.5% cannot hold the markets up, which makes me more convinced that over these few days we have probably observed a temporary bounce up within this intermediate cycle declining phase. And over the next few weeks we will probably see stock markets drop and give us a lower low. As I mentioned in one of my previous videos, often these 4-year cycle lows retest the 200-week moving average. That means there is a chance to drop all the way down to somewhere around 2650 on S&P 500 over the next few weeks. However, over the next couple of weeks, on the 18th of March, during that FOMC meeting, the Fed might try to push the markets higher. So I do expect a lower low over the next several weeks, but for now there is no certainty that this lower low is going to reach that 200-week moving average at 2650 because the Fed seems to be as active as it was during the global financial crisis in 2008 in pushing the markets higher. So for now, in my personal stock-related portfolio, I have mostly cash without counting the stocks that I hold of nice dividend-paying companies which I don't usually trade. I bought them a long time ago and I just keep them to collect a nice dividend. Again, in the part of the portfolio where I trade stocks, I am now in cash. Next, let's have a look at gold. Some of the viewers wrote in the comments that they were frustrated that they sold gold a few days ago with this spectacular drop. As I mentioned in my videos and other posts on YouTube, I'm also completely in cash in my part of the portfolio that is related to precious metals. However, I'm not frustrated in the least bit. And let me tell you, there is no reason for you to be frustrated at all. Remember, this big green candle in gold price was the result of an emergency rate cut by the Fed, which neither you or I or anybody else could have actually predicted or expected. Remember that the last emergency rate cut only happened during the global financial crisis when the stock markets were really in a lot of trouble. So no need to be frustrated about the fact that you didn't expect the unexpected. Let me ask you this, are you frustrated every day that you didn't find any money lying around on the ground? I don't think so. The same logic applies here. Without that unexpected Fed rate cut, there was a chance for the second daily cycle to continue lower over the next several days before the bounce into the third daily cycle was going to take place. Now with this rise, it looks like the third daily cycle has started, and the low of the previous second daily cycle occurred right at this 50-day moving average. The second daily cycle lasted for 45 days. That's within a normal duration for a daily cycle, which also confirms that possibly the third daily cycle has started. However, remember, nobody knows the future. What we're doing here is we're trying to assign a range of probabilities to different scenarios and act based on which of the scenarios is more likely. So here are the two scenarios that I see taking place in gold. First scenario, which is less likely in my opinion, is that gold continues to drop higher to give us the actual low of that second daily cycle, sometime around the 2 month duration for that daily cycle. That might happen somewhere near the lower range of the Bollinger Bands at the price range of somewhere between 1540 and 1550. This range has acted as resistance and support at least 4 times since August last year. I would give this scenario only a 30% chance given the strength in gold at the moment. A more likely scenario, in my opinion, is that we have started the third daily cycle. This daily cycle is only 3 days old, so there is still potential for gold price to continue upwards. However, the intermediate cycle is relatively mature, so we might not see a spectacular moves up in gold in this third daily cycle. There is a chance that gold gradually increases up to that target that we mentioned in some of the previous videos of 1725 before dropping into the declining phase of the daily cycle and of the intermediate cycle. I would give this scenario a 70% chance. Although within this 70% chance scenario, there is also a likelihood that we're not really going to see higher highs. There is a possibility gold only retests the recent highs of 1700 before going down into the declining phase. Seasonally late spring and early summer is usually not a great time for gold price. So this is what we see on the gold chart itself. And looking at the miners, although today on the 4th of March, gold is only down a little bit. Yesterday, near the second half of 3rd of March, GDX didn't manage to stay above 29 and finished the day below that 50-day moving average. So we see that miners are not as strong as gold itself, and if you felt frustrated that you were in cash without holding any of the miners, notice that the miners didn't run away as much as they could. They closed below the 50-day and 20-day moving averages. So for the miners, my expectation is that if gold stays within that 70% scenario where it retests 1,700 or even goes up to $1,725 per ounce, miners might probably retest that upper range of the Bollinger Bands and the recent high of $31.7 over the next couple of weeks before entering the declining phase. That would be my most likely scenario. If instead gold drops over the next couple of weeks into the actual low for the second daily cycle, miners might also follow gold down before everything bounces into the third daily cycle a little bit later. This scenario is not a likely one in my opinion. Again, I would only give it a 30% chance. Now let's zoom out a little bit on GDX, and within this more likely scenario when gold price and miners gradually go up over the next few weeks, if gold manages to break above the recent high and possibly go to 1725 and even higher, there is a small chance that GDX finally breaks out of this long-term resistance. This resistance, somewhere at about $31.8, has held recently at the end of February. In September last year, that happened over here in August 2016 and even in August 2013. So that resistance has been strong for over 6 years, and if it's finally broken, there is a chance for GDX to go up to the next resistance level of 35.4 based on this March 2013 low, or even up to 38.5 based on this May 2012 low. So there is some potential for gold price to continue rising. However, the intermediate cycle is getting a little mature. It's 113 days old. So what would be my strategy in this case? Well, with GDX, once the markets open in US, I'm thinking of buying some GDX. However, I want to use a stop loss intelligently so that I don't risk too much of the portfolio. I think a stop loss of recent two lows based on the middle of January and early February lows somewhere at about 27.7 on GDX would be reasonable. That would give me a risk level of around 3% on the downside, whereas on the upside, if GDX retests the upper range of the Bollinger Bands, that's somewhere around 8%, or if GDX retests the recent high, that's over 10% return. And there is also a small chance that GDX breaks above that long-term resistance to go all the way up to 35. That would be amazing. So that is my view of the stock market, gold price, and gold miners. And let me wish you a nice and pleasant day. Let me remind you not to be frustrated about the things that you couldn't have expected. Let me also remind you to hit that like button, subscribe to the channel, and good luck in your trades.